Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. I'm very pleased to say that joining us now is the Bank of America Chair and CEO, Brian Moynihan. Brian, of course, in London, and we're here in New York. You're actually in our home, and we're in yours. So thank you, sir, for making that happen. Brian, let's get to this leadership shake-up, because we've got a lot to talk about. 8 lines of business, 2 very prominent individuals in this bank, at this institution. How do you and the team plan to split up responsibilities?
Well, it's good to talk to you both, and thank you for coming to our great corporate headquarters. Hopefully they're treating you nicely out there. This is a recognition of 3 teammates, Dean and Jim and Alistair, and the contributions they made to our company, and bringing Jim and Dean to help me leverage across the businesses. And there's a lot of initiatives we conduct across the company, our growth work streams, our operational excellence, our AI initiatives and things, and I've asked them to come help me. Meanwhile, it also frees up space for that talent group, and you're talking to a lot of them today, whether it's Lindsay or Eric or Wendy and others that continue to drive those 8 businesses for us and own the businesses, own the responsibility for P&L, and there's a lot of talent at that level. So the idea is to bring them to help leverage my time, leverage the company's time, leverage the company-wide initiatives, and then let that talent that drives those businesses keep making great progress.
Brian, there is an obvious, perhaps uncomfortable question. Some people might have responded to this and just thought, is Brian setting up for succession? Or is this just about changing how the company's run?
Well, long term, we have one of the duties that I and the whole management team owes the board of directors is a series of candidates that have the experience to run this company over time. I'm not going anywhere in the short term, but in the medium term. But it takes a while to set that up and get people used to the size and scale of this company. So you all report all those ins and outs of succession. But the reality is we're a team and we're driving for it. There's a lot of talented teammates, and the board will have to make a decision someday based on the facts and circumstances at the time.
Brian, you talk about some of the new initiatives and looking forward to the bank, the Dean and the Jim that will be of the future partnering together. I'm wondering what you're hoping they can accomplish, whether it's the AI initiatives or beyond. What kind of projects you're hoping that they will spearhead?
Well, we have a lot of things going. For the last year, we've been working on some work streams to help drive expense efficiency and implementation of new technologies, and at the same time drive growth, how we take risk and continue to look at our risk parameters. And so what I'm asking them is and they've helped drive those while they've been doing their old jobs, and I've said, come do this full time, and that'll give us more leverage across the platform. Our company has a great reach. We have, we're all over the globe, and Bernie Menz and the team here out of London run all the international businesses for us. We're in a lot of countries, a lot of teammates around the world. We just announced 1,000 more teammates that we're building out here in UK, and they can help the company drive that and put the key of the top big company like ours is to work the seams, work the business connections. And so Jimmy and his capabilities as he works with the wealth management group and Lindsay and Eric on the clients that we have, especially in the higher end clients that he has relationships with who are hedge fund operators and things like that. So there's a lot of initiatives, but it's really about revenue growth, organic revenue growth, and expense efficiency, and also thinking through how technology applies. And it just gives me more power at the top of the house to join us, and these teammates have done a great job.
I imagine it's going to be United Front at the Investor Day in November, the first one in some 15 years. You mentioned the CFO, now Executive Vice President, Alistair Borthwick, said this: the most important thing from our perspective is we feel like we've got an opportunity to close a relative value gap. Brian, can we talk about that relative value gap? Where do you think that comes from? What is it that you think perhaps investors don't fully understand?
Well, as you look at the company, you have a great organic growth engine. So we'll do 1 million new checking households, and our average checking balances are 3 times, 4 times the industry norm, and we're building that up. What we're trying to showcase is what Bank of America is an organic growth machine on a very steady compounding basis. So if you look at the projection for our earnings growth rates by the street, they're faster than the average company as the balance sheet reprices and things go on. But what we're really trying to showcase is to put on the table basically the metrics that we run this company by across the 8 lines of business and how they work together, and then the international piece, and then AI and some of the other things we work on, the payments business, which is embedded in the lines of business but is a separate business. It really showed 3 things. We have a competitive position that no one else has. We just announced yesterday the largest small business lender. We have a competitive growth rate in the organic growth that's there, and then because of our the dynamics of our NII lift, which it will be growing, as we've told people, 6 to 7% this year, you're going to see the EPS keep kicking in and the operating leverage come into the business, and the return on tangible common equity keeps moving up, and that's what we lay out. But it gears off that good core organic growth with the right risk that we drive this company by.
Brian, as John was just mentioning, this is the first in 15 years. Why now? What changed for you, and is this going to be a new annual thing?
I think we have 35 analysts that cover us. We spend time at all the conferences. We spend time individually. But think about it, putting on the table where the company stands right now as we see after the pandemic and after the interest rate changes and after inflation fights and all that stuff. We see that people putting on the table where we are in organic growth and how it works together is critical. And I think, you should expect us to do it more often. We have a lot of connectivity to the people who actually own our stock and talk to them all the time, but this is a chance to sort of lay it all out so everybody can see it together and to look at some of these initiatives that are unique, like our employee banking investment initiative, our continuum, our Merrill Edge through Merrill Lynch and the private bank, and the ability for us to take a customer literally from the first bank account their entire life, and no matter what happens to them on an individual side, or a small business forming today that becomes the largest company in the world, or an individual trader that builds up a capability and becomes a hedge fund manager. The idea of these continuums and things like that are really important. And so we hope to put that on the table and make sure people see it, and then we'd annually update it, but sort of put a baseline on the table.
So, Brian, it seems like you're moving toward a greater degree of transparency, or at least availability, at a time where the president is talking about potentially moving from a quarterly reporting system for public companies to a 6-month reporting season. Do you think that would be helpful for you as a business manager if you had to report less frequently in terms of filing?
In the end of the day, we run the company along the principles of responsible growth and how we run it. So it won't change how we run the company. It may change how often we have to talk about it. And inherently, if you do it 2 times a year versus 4 times a year, you'd save some money and some effort. But my guess is our investors are going to demand from us more constant reporting. So we'll see it all play out. It's an initiative that was talked about over the last several years. If it's going to get done, it has to be done the right way. So it remains in place. And we look forward to what comes out of the SEC in the process. But on the other hand, we are very transparent in what we do. We put a lot of information out there, things like our digital capabilities that no one else reports on, quite frankly. And again, with the Investor Day, we'll be able to show that and really challenge people to say, look, if this is what's going on, if you've taken a company that had 300,000 people 15 years ago that has 212,000 people today and applied that technology, just think as we start to apply AI more fully. We already have Erica, 3 billion customer interactions, but as that applies more fully, you'll see the ability for us to continue to manage the headcount in the company well while the revenue keeps growing. And so I think we'll report on that more often than every 6 months is my guess, based on the demand of our investors.
Lisa, I imagine some CEOs might welcome this.
Yes.
Even if some investors don't.
They might welcome this, but will they be allowed to actually follow it by their investors? And that, I think, is what Brian is alluding to.
I think investors will demand much more transparency. Brian, I want to talk about an initiative close to your heart. The news that we got about 25 minutes ago, that you're increasing the minimum wage to $25 per hour. I remember a very early conversation with you, and this is something you're very proud of. This has gone up from, say, 15 several years ago. Can you talk to us about why you've maintained this commitment to driving the minimum wage higher at Bank of America?
Sure. So let me set two things up. One, over the course of today and tomorrow and yesterday, we've announced a series of initiatives. One is to locate 1,000 new teammates in the UK that will work in our operations group, and that was announced by Bernie and Tom Scrivener. A second one is to recommit to our military hiring at Bank of America, 10,000 military veterans over the next 5 years. We've done this from time. We have about 20,000 working to increase that. Another is to increase 8,000 people from community colleges to present an opportunity at Bank of America to further the career and get into skills-based training. That's a doubling or tripling of what we do today. And then the 75 branches that we're deploying and the teammates there. And the third piece is the minimum wage. And so we started on a travel a number of years ago with a view that we want teammates to come to Bank of America with a career mindset. So join us. So today we're announcing $25 an hour, which is $50,000 for a starting salary across the country, and higher in some places where the prevailing wages are higher, obviously. But what that gives a teammate a chance to join our company, spend their whole career here, and support their families. So not only is it the $25 an hour minimum starting wage, it's the benefit structure, which is a full 401k match, a full benefit cost that for the teammates in the brackets of $25 an hour, we basically dropped their premium coverage in healthcare in 2012 from $500 a month to $250 a month for family. Have never raised it to provide great healthcare for them, and then our child care benefits. So it's a package. So where does that pay back for the investor? Where that pays back to the investor is the turnover rate when we started this program in the high volume operations groups and the branches was 20%. It's now down to basically 10-ish% or so, and even below that. That stability and that career mindset allows us to do a much better job for our clients. And what you've seen is the attrition of teammates has gone down. You've seen the attrition of customers gone down, and you've seen our customer scores dramatically improve over the last 15 years due to this relentless pursuit to be a career employer. So yes, we're very proud of the $25 an hour, but there's an economic benefit for the shareholder, and there's a great positioning for the teammate at the same time.
Brian, I wonder also what it says about the situation, the current environment. It's very strange that we're going into this decision with the Federal Reserve talking about 25, 50 basis points of rate cuts and maybe more. Your team has talked consistently throughout this morning about the amount of resilience they see in the US economy. Pay hikes like this aren't the kind of things you would typically see in a recession. What's your sense of just how tight or weak, loose this labor market actually is right now?
Well, I think if you think of 23 summer, the Great Resignation, it was very tight. Then it loosened up, and it's more imbalanced now. So our turnover rate in our company is running about 8%. Even in places like tech programmers, of which we have 30, 40,000 of them, we're running in double digits is now in 3-4%. And what that shows you, the bid in the market's different, which then shows you people are being more careful at headcount. And you heard some of my colleagues talk to you about that. So I think the unemployment rate is still low, but I think businesses are being much more careful in managing their headcount for a number of reasons. One is to get by understanding how all the policies are coming at them fit together. I'm talking about U.S. businesses mainly. And then secondly, they're also making sure that they're careful, and I heard some of my colleagues talk to you about this earlier. As you think about this application of technology, we know what this does. We have half as many people working in the consumer business than we did a decade plus ago. We have half as many people working in operations. We know that as these technologies can apply to our legal department, our accountant, our finance department under Alistair, our risk department teammates, we know that if we manage the headcount carefully, we will do it. So we look at headcount very carefully and say, don't hire people unless you really need them. Not because we're trying to save money, because frankly, from a human management capabilities, we don't want to have people who won't be able to have a career here. So we just hired 2,000 plus kids from school. So we brought in all those new talent. We'll hire these 10,000 veterans. We'll hire these 8,000 people from community college. But each month we get the right to make a decision on whether we're going to hire about 1,300 to 1,500 people, and we're just managing that very carefully. So I think we're an example of what's going on in the broader labor market. You heard Wendy and my colleagues talk about it. All the companies are trying to manage this and make sure they get the headcount right, because that is a major expense for a lot of firms.
Brian, about a year ago, you were talking to us about the ramifications of AI and the explosion of efficiency. And you said that you think that headcount could remain about the same at the bank, even as the business continued to expand just in total size. I'm wondering if that's shifted, if you still see that as the natural progression of the relationship between the adoption of machine-based learning and the relationship to your headcount.
so there are two things. Now, one, I think the time we were talking, we were probably closer to 216, 17,000 people or 213,000. So I think we'll be managing this down. But remember, at the same time, we're managing out through operational excellence and efficiencies of applied technology. We are deploying. So we're adding, Wendy's added commercial bankers in all the markets, and Sharon and the team added business bankers in all the markets, and Katie and Lindsay and Eric adding financial advisors and private bankers. So we're adding front-end people, sales traders, et cetera, to keep building out our capabilities. And so there's a reinvestment going on. The key to that is really redeploying people and reskilling them. So when we bring these 2,000 plus teammates in who just joined us in the last month and a half, we have to be more mindful about training them along multiple dimensions than we might have been 2 or 3 years ago. So I think, yes, I think ultimately the human being content of our work product would probably come down, but if we manage it right, it'll be flat to the same amount of people, maybe down a little bit, but all paid more and all being applied to the highest value tasks where, frankly, the machines can't do the work. And that's the important thing. We know what this AI can do in today's world. Erica's been out there for 7 years, 3 billion customer interactions, 20 million customers using it all the time. We see what it could do. We took that and put it in our commercial business. We took that and put it in our internal process. We got other models to help in Jimmy DeMare's business in terms of a thing called Optimus and things like that. There's a lot out there, but what you're learning is there's still augmented intelligence, and that will be what's driving the near-term efficiency. So yes, I think the headcount management is one of the core tasks that managers have to take seriously.
I'm just wondering, Brian, as you train all of these new students, how do you make sure that they stay with you and don't go to some of your brethren across the way in the private asset sphere?
Well, we provide them a good opportunity, and look, they can go other places, but we've been able to retain enough that we're completely happy. And look, even for our clients, frankly, if they hire our teammates, it's not the worst thing that happens in all our businesses. But the reality is that we want these teammates to have a career mindset. In October, I'll celebrate our teammates have been with our company 50 years, 55 years, 60 years, et cetera. And you hear their stories, and their stories of I joined this company, I worked, in a summer internship, I may even work part-time during college, I became a full-time employee, and I started doing this, and now I do that. And those are wonderful stories. And we have them tell those stories to our teammates to show you that you can have a long-term career at a company like ours, and that's what we want our teammates to come in with. They may not stay in trading or investment banking or corporate banking, but they'll have long-term capabilities here. And you've seen that even top of the house. Alistair was a capital markets head, and now he's the CFO, and so that goes on throughout the company.
They swear an oath of allegiance.
Yes, exactly.
Didn't you see them lining up this morning?
They came in.
Before they come in.
I promise on my cappuccino, which is very good, by the way.
Brian, I want to talk about the main event that takes place later on this afternoon. I'm not going to ask for your guess. I know how much you respect the team behind me and some of the official forecasts of the bank. I want to understand from your perspective, looking across the 8 lines of business, whether you see an economy, market activity that demands a rate cut from this Federal Reserve.
Well, you've had the benefit of all our experts, and we have the talented, extremely talented research team, and you also have some in line of business teammates talking about what they see out there. I think you have to back up. If you think about last year this time, the projected growth rates for our team was probably 100 basis points higher than it is today for 25. And so that deceleration of growth, the prediction that was largely based on a couple things. One, rates would stay higher because inflation was kicking in, the impact of the uncertainty in tariffs, et cetera, et cetera. All that's coming through the system now, so you're seeing some certainty fall into place on this. And I think also inflation was coming down, and I think so the tension the Fed has to deal with, and you've been picking at it all day, is the tension between a higher inflation rate and ultimately where Fed funds could settle in at. And so whether they do 25 basis points today or 50, people have to keep in mind the growth rate in the economy was brought down, and now it's starting to go back up. So next year is predicted to be better than this year, and the year after is better than that. So you hear our teammates talk about the economy growing back out. And that then means we're on the other side of it. And so the Fed has to adjust to the inflation picture as it got more in control. They can come down. They came down 100 basis points already. They can keep coming down, but they got to be very mindful of the inflation side. And so I think when the people get in the room and they see the data, they have to think it through. The big news since that you referenced earlier was the labor market's gotten softer, so that gave them concern. So I think, the market believes and our teammates believe they'll cut rates. But I think the key for people is deceleration of growth, and will the growth reaccelerate? You hear our teammates seeing that. We're seeing consumer spending strong and all those things, which would indicate we'd see the acceleration. Next year's better than this year. Unemployment is not expected to go up a lot, even though the employment picture may be softer. But the most important thing is the long-term interest rate scenario people projecting is a more normal rate environment that we saw before the financial crisis. Say 3% plus or minus on the Fed's fund rate, 4 to 4.5% or so on the 10-year rate, and a curve that's not inverted, that's normalized between that. The important thing is to get back to more of a normal environment, frankly, with maybe a little higher inflation, because the great debate about 2% is something you can get lots of experts talk about. A little higher inflation, a little faster growth, and then, frankly, that'll help with some of the debt carry and other things going on in the U.S. economy.
Brian, it sounds like next year you see the bigger risk as potentially a surprising bout of inflation and some sort of downturn. Is that correct?
Well, I think the question is how do you tolerate the inflation and the nature of it, what's come from. But, and I think that's the tension of all this, I think, is next year as you get to the second quarter, as these policies are now in place and are behind us, are you going to see the acceleration in growth and where our businesses start investing even faster? If you listen, I think if you asked Wendy about it, she would tell you her commercial customers that have lines of credit are still borrowing less as a percentage of their availability than they did in sort of the 17, 18, 19 timeframe, where rates have been moved up and the economy was growing. And so why is that? They're probably not seeing quite the opportunity, and so they're trying to sort this all out. And I've got the benefit and the honor of leading a company that has this talented team behind us, and all the talent and money we spend on research and everything. If I'm running a company that the three of us owned and it was a manufacturing company, I got to figure it out all myself. That tends to hold people back. So that would be the case for acceleration. And then the question is, if rates stay a little higher and the growth is higher, that's not a bad place for America to be.
Brian, just before you go, I wanted to sneak this in. One final question. Whose door do I need to knock for World Cup tickets? Who makes that happen here?
Well, you didn't bring David Tyree on, who's doing all our marketing and work, and so he's the guy that's got control of the tickets, but he does a great job for us. Look, our relationship with FIFA, we did the Club World Cup, which was sort of the warm-up, and next year, and you'll see us accelerate our efforts. We have great capabilities for our clients, but most importantly, this is a chance for America to showcase football, soccer as we call it. It's a case for these cities that are hosting to put on a great show, and I think I can see the enthusiasm building, and you're not the first person that's asked for tickets, John.
Stay with us. More Bloomberg surveillance coming up after this.
Savita Subramanian, the head of US equity and quantitative strategy, writing the following. It is difficult to be outright bearish on risk assets with signs of profits continuing to accelerate alongside a Fed that is more likely to ease than hold short rates. Savita plus Jill Carey-Hall, the head of US small and mid-cap strategy at Bank of America, joins us now for more. Guys, good to see you both.
Great to be here.
Thanks for being here. Savita, I want to start with you. A central message of your research for a long, long time. Never underestimate the resilience of corporate America.
That's right.
Is that a mistake people have made it too many times this year so far?
Yeah, I think we even made it after Liberation Day in thinking that, we were going to see companies not being able to guide, not being able to navigate this really complicated environment. And what we saw was corporates handling this with aplomb. And essentially, they continued to guide on earnings. We saw no paucity of information. We heard a lot of companies talk about their tariff mitigation tactics, which I think was interesting because they've seen this before. They went through this in 2018. Obviously, this is a little bit more extreme, but companies know how to manage. They just need a plan. And I think that was what we were heartened to see.
It's odd to have this conversation about 25 or 50 from the Federal Reserve. At the same time, the equity market is close to all-time highs. And you and the team here at Bank of America are essentially forecasting an acceleration in earnings for 2026. Can you make that make sense to people at home listening to this?
Well, yeah, we're actually forecasting a slight deceleration, but a broadening out of earnings. And what I think is really noteworthy and what investors need to pay attention to is the idea that the 493 is actually back in the black. These are companies that are making money. So it's not just tech all the time, which has been the story for the last few years. I think what's also interesting is that tech companies are spending, and they're spending on everything. They're spending on power, grid, which is actually positive for overall economic growth. It's positive for commodities. And I think that's the message we're giving investors today. What's really thwarted broadening this year, I think, is just this bomb of tariff uncertainty that was dropped on April 2nd, and we're at a point where clarity has improved vastly around that issue.
Not just the 493, the 2000. And I am wondering, Jill, yes, we have seen a complete outperformance from the Russell 2000 of late, and you actually increased your expectations for some of these companies after being pretty sour on them earlier this year, especially after Jackson Hole. How much is this entirely predicated on what the Fed does, rather than what Savita is talking about, which all sounds lovely, but it's been in effect for quite a while?
Right. Well, I think the Fed has certainly been one of the biggest drivers of the Russell 2000 over the last year or two. Some of the biggest rallies and sell-offs we've seen have been around Fed expectations or data that feeds into that. So I think, the expectation of cuts coming is certainly more positive for the Russell and should lead it to outperform near term. But I think also what investors have been focused on, perhaps more so than usual, has been the profits backdrop, because a year ago, everyone was expecting that by mid-2024, small caps would have come out of their profits recession, that earnings would have broadened out and been outpacing large caps, and that just kept getting kicked out. And we finally saw small caps come out of the profits recession this earnings season. We saw a big beat by these companies. We saw much better guidance. So that's been a positive sign. I mean, the sales data, the top line growth was a bit more lackluster relative to large caps, so that's something to pay attention to as we go into the next earnings season. But the fact that profitability is finally recovering and speaks to that broadening out of earnings is a positive.
Is the pop on the heels of a potential Fed rate cut because of just simply a valuation story, that lower benchmark rates make it more attractive on a relative basis? Or is it that actually they will borrow more, that they can do more that they aren't doing now, whether it's engage in M&A, whether it's engage in acquisitions, whether it's engaging in hiring plans?
Right. I think it's a bit of all of that. I think, but for small cap companies, they have a lot of debt, much more than large caps do. They have a lot of refinancing risk. They have a lot of debt that's coming due over the next 5 years. So there's a big focus on their interest costs at a time when their earnings have already been struggling for several years now in this profits recession. So, the Fed is likely a bigger driver than usual, given that focus, given their leverage profiles right now. So combine that with some of the positives we're seeing on the profits backdrop, and I think that's a positive near term. Now, the sustainability of the rally, I think, will depend on revisions, those top line trends, the manufacturing recovery. Small caps tend to be very sensitive to the ISM manufacturing indicator, which has struggled to get back above 50. So a lot of these factors will be what we're watching to see how sustainable this rally in small caps could be.
We had a guest that came on the program a few weeks ago that said to Lisa, "Can you name a company on the Russell 2000?" Very few people can. When they buy the Russell, what are they buying? What's the concentration risk around, say, small caps relative to Savita's world large caps and the S&P 500?
Right. Well, there's some sector skews, certainly, in terms of more biotech. There's a lot more non-profitable, non-earner type of companies within the index, whether it be in biotech, small cap software, regional banks, REITs. There are some of these areas that are bigger within the Russell. But I think what's important is that there are still risks to the index. There are a lot of, like I said, non-profitable companies that's elevated versus history. So I also think it's a very good environment to pick stocks within the index. Our analysts here cover over 900 small and mid-cap U.S. stocks. So, amid all of these uncertainties, whether it's tariffs, whether it's how sustainable is this profits recovery, if you can focus on companies that, have better earnings revisions, have stronger margins, there are a lot of beaten down stocks within the Russell, and small caps overall are trading at these big relative discounts to larger companies. So it is a good good environment for stock selection. We've seen the interest there. We saw a big uptick in attendance at our recent SMID-cap conference. We've seen investors buying small-cap stocks this year.
Well, when you broaden out, this sort of complicated backdrop goes to Savita, your recent change, or both of your recent change in the outlook ahead. You only see a 6% gain from here until 12 months out, until the same time next year, to about a 7,000. That's far below where a lot of other people are. Why not higher, especially given the expectation for earnings growth to truly reaccelerate?
Well, I mean, here's the problem. The ballast of the S&P 500 has been tech, and tech earnings are slated to decelerate. I mean, these companies are really big. It's harder to grow as fast. These are companies that are spending more money on CapEx, so they're returning a little bit less capital than they used to, doing less buybacks. So I think that's the other side of the story, is the theme around AI. And I think what we would need to see a much higher return and even a positive surprise in earnings at an index level is continued AI monetization, big surprises akin to what we saw in the second quarter. And it's harder and harder to forecast that as we move forward and these companies get bigger and we're more deeper into the AI monetization cycle. So our analysts are bullish, but we are still seeing a deceleration in that area of the market. And then the other kind of simple fact that we all know is the market tends to anticipate earnings recoveries. We've seen some great returns this year. I think that's in anticipation of what's to come. Typically in the best earnings years for the S&P 500, the market actually posts kind of, meh returns. So I don't know if we're going to see another blockbuster year of returns, but I do think that earnings are going to broaden out, and that's going to be an exciting story.
Given the focus today, anticipating the Federal Reserve decision, how relevant is that to your world?
Look, I mean, I know everyone is obsessed with the Fed, but I think that long rates are much more important for equities, and we've talked about this. So, short rates have actually done very little to stymie large cap company performance because their balance sheets are healthy, they have less floating rate risk, they learned their lessons during the financial crisis and really managed their debt risk. So I think the long end is more important, and here's where it gets complicated. If the Fed is cutting but inflation has not been, sufficiently managed, I think that's the risk. If the long end, absent yield curve control, the long end, I think, is really, potentially more dramatic for the S&P. So that's what we're watching.
Is that something you're focused on, the risk of a repeat of what we saw last year when the Federal Reserve cut interest rates and the long end actually sold off and yields rose by, I think, about 100 basis points?
Yeah, we had a real steepening. I think that's good for certain sectors and bad for others. One reason we're overweight financials, energy, some of the more inflation positive sectors that are geared to inflation. Those are sectors that can do well in that environment as long as this is not a disorderly increase in the long end, which is what, we all worry about, especially on this desk.
The good news is, so far through September.
Stay with us. More Bloomberg surveillance coming up after this.
Let's keep it on the Federal Reserve, sticking with the economy. The senior U.S. economist here at Bank of America Securities with this to say: another cut in October may be on the table if the labour market were to weaken significantly further, but it isn't our base case. Aditya joins us now for more. Aditya, good morning.
Good morning. Thank you for having me.
Thank you for having us. 25 basis point cut expected later on this afternoon. How much guidance can they provide beyond just that?
I think that's going to be the key question. What does the dot plot show? So our base case is that the dot plot median will show only 50 basis points of cuts this year, so another 25 potentially in December. And the reason we think that it'll only be 50 rather than 75 is that if you look at the macro forecasts from the June SEP, they've actually aged remarkably well. Unemployment is on track to meet their forecast, so is inflation, and growth, if anything, will come in a little bit stronger. Obviously, you've already heard a lot about the risks of reacceleration here. So given that, and given that the dot plot median almost showed one cut back in June, even a little bit of a dovish move would still probably keep it at 2.
When you talk about a dovish move, there's a question about the actual cut or the signal going forward. Not just the signal and the number of rate cuts, but something Mark Cabana, your colleague, talked about earlier was the idea of the third mandate, the idea of keeping rates moderate over a longer period of time as one of the three pillars of the Federal Reserve. If that were adopted, how much would that change your outlook as an economist?
So moderate is not a clearly defined term. So we'll have to see if going forward, potentially different group of people at the Fed have a more specific definition of moderate. But for now, what I see is an economy that's probably pretty close to the neutral rate. You look at where stocks are, you look at the fact that productivity might be picking up, and I don't think there's a clear case here that the economy is screaming for rate cuts.
If that's the case, why isn't inflation more of a concern? Why aren't we seeing that baked into market expectations just a bit more?
So you are actually seeing inflation fixings showing a little bit of a pickup in inflation. Our core view has been that it's not just about trade policy. It's also about underlying inflation. And underlying inflation for us is stuck around 2.5%. And we think it'll remain that way going forward, which is why even as the tariff effects roll off next year, we only have the core PCE going down to 2.6%.
There was quite a difference between July Chair Powell and Jackson Hole Chair Powell. And I understand there was a big payroll report in between. But it was a difference in approach in how he anchored his view around the labour market that got my attention. He anchored his view around the labour market, around the unemployment rate in July. And then we got to Jackson Hole, and clearly he was spooked by the step down in payrolls growth. You've been focused on measures of slack, and now traditionally that's something the Federal Reserve and monetary policymakers would be focused on too. Have you seen a significant deterioration in measures of slack alongside this monster step down we've seen in payrolls growth?
So what Powell said in July, which was viewed as very hawkish by markets, was that even if payroll growth is zero, if the unemployment rate isn't increasing, then that's where break-even is, and the Fed doesn't really need to be concerned about that. And what we wrote at the time was it's one thing to say it, and it's another thing to walk the talk when you actually see the data. And that number, that 258,000 downward revision, I think it spooked the Fed. And yes, there's been some deterioration in signs of labor slack. You can look at the ratio of vacancies to unemployed workers. You can look at the labor market differential from the conference board. All of those are showing some increase in slack, but it's been relatively moderate.
Spook them into what? I think that's what we're wrestling with today. Spook them into a 25 basis point risk management decision, or spook them into we need to come out and convey to market participants today that this is the journey back towards neutral. And we think neutral is around 3, and we're looking to get there quickly.
The committee is going to be divided on that question. And the key question that we'll get answered today is, where does Powell land? Is he on the side of we need to do a little bit, but we don't need to do a lot? Or is he on the side of we need to go all the way back to neutral? We're in the first camp, but we'll learn more today.
How much are you going to take true signal from whatever Governor Myron has to say? How much is he the new lodestar, in some ways, of the committee in 2026, if not today?
I think it'll depend on how much the committee changes next year. That's still an open question. We don't know how many seats will be available on the board. We don't know how much turnover potentially there'll be amongst the regional presidents. So that's, I would say, very much an open question. But for this meeting, we know that Governor Myron will be an outlier.
Stay with us. More Bloomberg surveillance coming up after this.
I'm pleased to say that we're joined by Bank of America's newly appointed co-president, Jim DeMare. Jim, it's good to see you.
Great to see you.
Is it Jim or Jimmy? I'm always confused. Brian called you Jimmy.
You can call me whatever you like.
We're going with Jim.
Either's more than acceptable.
Jimmy, congratulations. Congratulations.
Thanks very much. Appreciate it.
It's fantastic to get some time with you. I want to start by talking about markets before we talk about the operational stuff. I've lost count of how many quarters that you've seen growth in the markets unit. What are we on now?
13 as of the second quarter. Earnings are coming soon. We have to wait till those come out, but we indicated at the Barclays conference last week and when Brian spoke before, mid-single digits for the market. So knock on wood, We should be at 14.
Where's that growth coming from, and just how crazy was the start to Q2? 25.
Yeah, I think for us it's been a story of having the additional financial resources to help clients execute on what they want to execute, because markets have grown, considerably in size and market value. And taking a step back from that, for us, our equities business, it's been a huge focus for us the past 4 years. Investments in, financial resources plus people plus technology, and then, within the FIC kind of sector, if you will. The rates business has been a place where we haven't done as well as we think we can, and we've seen a turnaround there as well.
Maybe the Fed will help you out, especially today.
a lot of anticipation, as you mentioned. Great deal of variance in terms of not necessarily this meeting, but what the next 6 to 10 months brings us.
John alluded to it, and I think it's a really important point. There's a tension between this push for the Fed to ease financial conditions, given the fact that financial conditions, at least you could probably tell us, but other people have told us, seem pretty easy.
Yes.
They seem like pretty free-flowing, and people can go out and borrow money if they need to. Can you square that circle for us?
I think what we've done a very poor job of is talking about financial conditions based on size of companies or individuals themselves. We've broken it down. You had Liz on this morning. We were talking about small business and what's going on there. Smaller businesses and on the lower end of the economic kind of scale, if you will, for individuals, they're more sensitive to short-term rates and floating rates. So, if you're a large corporation, you've had, easy access. The markets have been very favorable. You issued you refinanced debt back in 2021, and you locked in some very low rates. Homeowners did the same. Mortgage rates were below, 3%, and again, if you're a smaller business and you relied on floating rate debt and you don't have access to the broader capital markets, this will be a relief. So I think that's a story that people should focus on.
So I guess that another way of saying this is when the Fed started hiking rates, people were surprised that the economy didn't just tumble into recession. Are we going to be surprised by if the Fed cuts rates, how little it helps boost growth? Or do you think that it will boost growth substantially, that we will see M&A pick back up, that we will see borrowing increase even more?
I think we're going to have to, again, bifurcate it and take a look at different parts of the economy and see who's benefiting. But to your point on M&A and activity, for all the pessimism and climbing the wall of worry, I don't, there's a lot of activity happening across a lot of sectors, whether it's, tech, energy, utilities, power, data, financial services. We just saw, an M&A activity, and, there's more discussions on that. Healthcare, I don't know. Equity prices are high. Credit's
Look at how this
tight,
market's priced.
and people and companies are making money.
So where on earth are we going? The Fed's about to juice the whole thing. How are you thinking about things? You've seen so many cycles. What is this? What is this moment? The Fed's spooked by payrolls.
It's a very different one, that's for sure. There's some information we put out recently that showed, when the Fed is cut, almost I think it's been every single time, and I don't remember the exact number, but into a strong kind of equity market, we continue to get a rally for the next 12 months. So that's there. We'll get you the stats,
one thing, but can I just push this point? I want to understand from your perspective whether it's something more than that, whether some kind of great misallocation of resources is building here. I can't think of many times where I've met investors who are incredibly aggressive about the capex spend of a handful of companies.
Yes.
It's sent the equity market to all-time highs.
Yes.
And the Federal Reserve, again, is about to come out later on this afternoon and juice the whole thing by even more potentially. I understand what they're responding to. It's the payroll story. I want to understand the consequences from a market perspective, just how dicey things might get further down the road.
Again, I think we have to see a considerable drop in longer-term rates to really get that traditional impact. We had an inverted curve for an extended period of time, which everybody indicated should indicate a weakening economy, which we didn't see. And to your earlier question, I don't think we ever had in history fiscal and monetary policy at odds, and that's what we had. I mean, everybody talked about, well, rates are up 400 basis points. Well, we also had the largest spend by the federal government, in history. Not only in absolute dollars, but as a percentage of the economy. So the policies weren't aligned. We talked about it a bit then. 2 years later, 3 years later, we're talking less about it. But I think it's going to be, is this going to be inflationary? I think people have to also think about fiscal policy and what's going to happen there relative to what the monetary policy is.
There's also the idea of deregulation, which we've seen quite a bit, and that's one reason why people have been very optimistic on the banking space. Does that allow you to take more risk and compete more significantly, say, with some of the private asset managers that have really made more headway into the space?
Yeah, I think for us and for the industry on regulation, it's more about clarity, which is one of the things that we've talked about a great bit, whether it's stress testing, some things on SLR, GSIB. Those are all things that I think play an important role in regulation and in a safe environment. But a lot of questions around were they too restrictive and compounding as opposed to kind of catching the bubble or the balloon from squeezing out in another direction. I think one of the in the broader economy, I think there's a lot of regulation that's occurred that we're less familiar with because we're not in that environment. But if you go across the country in many industries, the excitement is around less regulation there. I think it's going to be less about us, quite frankly, and more about for the broader economy.
I wonder how much we keep talking about the dollar as the backdrop here and how much it's been weakening. And I wonder for you, as the head of capital markets, the co-president of a bank that has America in its name, how much more difficult it is for you to compete globally at a time where there's a real question about U.S. policy, about the dollar, and about what the relationship is going to be.
Yeah, it's certainly, it's certainly a topic, meaning the dollar. We're a global business. Yes, we are. We are Bank of America. We have a dominant, position in the U.S. We've grown our, international business, which I didn't highlight when we're talking about areas of growth, but international is a focus for us, not expanding beyond where we are, but just being more meaningful in the regions that we are. And, we just look at it and say we have global capabilities and, we can transact and warehouse risk where we need to, for clients. One of the big, I think, misunderstandings or where it's not thought through enough, it's going to take some considerable time for this to occur. We're looking at weakness in the dollar 10%, 15% versus its peak. We're still the largest capital markets to invest in, and you just have to keep that in mind.
I wanted to finish by talking about you.
Yeah.
You've had a pretty tight remit for quite a while.
Yeah.
Are you excited about the prospect of stretching your legs a little bit, having a look at other business lines?
Yeah. I mean, I've been in the markets business 35 years in different, capacity, but I've always had interaction across the firm, whether it's been investment banking or corporate banking or whatever it may be. And I think if you take a look at, these areas of where Brian talked about organic growth and where we can do it, I think there's some considerable opportunity for us to be more consistent in our delivery. We did it in the markets business. I tried to de-emphasize FICC versus equities and think about markets and how we can deliver for clients. And I just view this as an expansion, of that and trying to help everybody bring that to fruition because, ideas are great. Execution is everything.
Does that mean spending less time with these guys? Are they going to miss you?
I'm going to miss it. I've sat on a trading floor for 35 years.
Yeah.
It's a great thing. It's been a great experience. It's given me a lot of opportunity. We have a lot of talented people that, as I said in the meeting we had earlier in the week, I know everybody's saying congratulations. Now the next question is, what about me? Which is for everybody else in the room. What does this mean for me? And, we're going to be making those decisions over the next couple of weeks. But we're pretty excited about it. Team's pretty excited about it. And response has been very good.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.